Oh. Good morning, everyone. Give about another 4 or 5 minutes to get this thing rolling. Make sure you guys have your questions ready, except when it kind of runs as an open Q&A. I think it'd be very beneficial for a lot of people to be able to ask their questions and get some answers and get some different takes on different things. So, but a couple more minutes and we'll get things rolling. All right, guys, we'll get this thing rolling. Well, good morning, and thanks again for hopping on. I'm sure we'll get a couple stragglers to pop on this as we get rolling. But like I said, one, keep it probably really brief today. I mean, probably shouldn't go more than a half hour, depending on the number of questions you guys give, which will be, like I said, the more the merrier for sure. Before we get into that, there's one other thing I do want to cover, which we didn't not talk about this much last time, but it's about 4 different points. I call them situational concepts, and and what those are is basically my thought processes. So these are kind of the 4 types of leads that you kind of come across, or the demographics of people that you do see, and there's kind of how I break those down into basically being what makes the most sense, where am I usually heading in terms of products, design, style, and so forth. So running through these, like I said, it's like I said, nothing too difficult, but it kind of gives you a good perspective on when you're getting leads. You're looking at the ages, depending on the lead card, if it has ages, birthdays. Some people, they kind of want to get a good foundation or basis of what am I gonna do if I see this person? If they're actually home, what options am I going to be able to show these people? So this kind of helps break that down and give you a clear-cut thought process of what you should be thinking or different points you should be talking about inside your presentation to kind of start steering them and gravitating towards certain types of concepts. So the first one to open up with my favorite, or one of the easier ones, is the young and healthy. So that's usually going to be your people between 18 and 45. I mean, the main focus here is it's really trying to find out what their main objective really is. If it's just the death piece, is it the living benefits, is the money back option? Just depending on that lead card and what they filled out, just really figuring out what were you looking for when you sent that form back in. So it sounds really basic. That's kind of the trend for all of them, but for this one especially, because the younger people, they can go either way. There's some people that are more financially savvy than others, and they see the value of it. And there's other people, they just fill out the form, and you really have to spend a lot more time educating them on how this works, what it does, what are the benefits of it, why people do have this, and kind of relate to them in terms of what their parents may have done or may have had previously. So it's really trying to tie that all together into one nice little basket for them. But in this concept, I mean, what I'm usually looking for is once I understand what they're looking for in terms of, like I said, if it's just the basic death piece, disability, money back options, or some living benefits, it's really trying to get them into understanding what we're trying to do is protect the house. Somewhere to happen to you, your family gets taken care of, whether it be future family, spouse, children, so forth, or if it's parents, the house goes back to them, give them an option to figure out what to do with it. But one of the main things I try to do in this concept is to load them up. So what that means is basically they qualify for everything, so they're going to get everything. Not only because it makes sense to have it all, have a one-stop shop, give them the full package, but also some of the carriers, especially some of those younger people that have smaller mortgages, is very difficult to hit the actual minimum premium. So like American Amicable, it's a minimum $25 premium. Sometimes it's difficult to try to do an 18-year-old on a $100,000 policy for 20 years. It's usually not going to hit the actual minimum pricing. So in order to get it to over that hump of that $25 or whatever the carrier's minimum price is for those carriers that offer it, you have to add in some riders. So when on a young, healthy person, I mean, what I'm trying to do is I'm going to give them the return of premium option, some disability coverage to help take care of the house payments, as well as they're going to always have that standalone death benefit as well. So it's really the load them up. You're getting almost everything in a one fine knit package. Other typical products for, like I said, 18 to 45, you're looking at 20, 25, and 30-year term options. Usually look at return of premium, disability, waiver of premium, or accidental death riders, living benefits. And then, like I said, for some of the more financially sound, you kind of start gravitating toward those universal life options to help kickstart some additional retirements. That could be in conjunction to or separate from, say, a return of premium option. So it all just depends on what they're trying to do and where they are financially at that point in life. But I mean, this is kind of the good age too. Like I said, going for the mortgage protection sale, cover the house, then like I said, also pitch them on some of the universal life products as a separate entity or a separate savings account for them to actually use. So it's not always going to be a one-stop shop for both of those options. Like I say, it's okay to write two different policies. Some people, they just want to have a better savings program, get the bare minimum on the mortgage side, cover that piece, and you're writing two apps for two totally different things. So that is definitely totally normal. Don't be afraid to do that. Next one's probably one of the more popular or more so common ones would be the middle-aged and middle market America. That's where you're looking between 46 to 60. Like I said, from the other bracket, nothing's really gonna change. Only really thing different is going to be price point. So here you probably start seeing a little bit more some medications pop up, more frequent tobacco users. Those are really going to be your only obstacles. Some of the techniques like we covered last week, we're looking at maybe ground floor concept for the person that's strictly looking for a disability plan and get them to understand the bigger picture of it. What if you passed away instead of just getting hurt? Critical period plan. So this is a nice segment too for some of those people. You're only trying to cover 2 to 5 years worth of house payments with a term product. So they're still healthy enough to get term, but maybe for budget reasons, or if the wife is planning on selling the house and not necessarily keeping it, you might look at that critical period plan to help transition for that 2 to 5 year cushion. And like I said, the one I love the most is going to be the 50-50 plan. So this is kind of that segment, especially when dealing with those tobacco users, is using the 50-50 concept of taking the house payment, cutting it right in half, and doing, say, 100,000 natural causes with 100,000 accidental to get 200,000 total coverage of death by accident. That's, like I said, that's the one that's usually some of those older ages. They have some of the bigger mortgages, and you're trying to get it to where it makes sense price-wise or budget-wise. That 50-50 concept is going to be the one that's kind of basically hopefully bridge the gap or highlight some of those other options to make it look a little bit more appealing in terms of price point. Because, excuse me. But, I mean, it's not always about trying to get the biggest policy or selling the least amount of coverage. Showing those breakdowns between those three option closes, your high, your middle, and then your low end number. Sometimes it doesn't mean they're always going to pick the lowest number, but it could make those other options look a little bit more appealing. So for the extra $20, the extra $40, getting the whole entire thing covered versus that 50-50 plan, or vice versa. Hey, for saving the $40, we kind of get the whole thing covered. Or if I die naturally, it still takes care of 5 to 7 years of house payments. It still makes sense for us, but this is what fits for our budget currently. So like I said, those Those options work to your advantage on either way. You end up slicing it, but it's just to give them an option of, or the appearance of that they're getting to choose what option makes the most sense for them. So same type of product lineup. In this option, you kind of throw in that 15-year option. So you usually have 15, 20, 25, and 30-year terms. I mean, some companies still let you do the return of premium, most to age 50. Americo does it to age 60, unless you're using a universal life product where you can go up even a little bit higher. Still waiver premium, accidental death riders, living benefits for sure, as well as this in this segment, some carriers start their whole life at age 45. For example, like Mutual of Omaha, being able to, like I said, plug in some of those payment protection plans or something of some of those more permanent style products, it's a good place for it. Aside from your Liberty Bankers and so forth, where they do go a little bit lower in age. Once again, using a universal life to help kickstart the retirement accounts as well. Be able to use some of those permanent vehicles that build interest. Next category would be the retirement era. So this one is kind of that tricky gray area, as I would call it, because these clients can go either way. They can go term still, or you can still look at doing payment protection using the whole life vehicle, or even the critical period plan using the term vehicle. And here, I mean, the big key with the retirement era is really understanding and digging into what are they planning to do? What is their pain point? Not only from a financial standpoint in terms of how is the budget going to change from Social Security and pensions to what's the wife or the spouse's ultimate goal? Keep the house, sell the house. Are they able to financially afford it still? Are they going to have to be forced to downsize? So the retirement era, I mean, can go a lot of different ways. Luckily, we have carriers to be able to cover on both sides of it. But as an agent, this age bracket is where you definitely want to spend a lot more time and understanding the different concepts and kind of knowing them forwards as well as backwards to be able to really effectively help those people and know which way could make the most sense. Like I said, usually after age 70, I try to avoid selling term unless I absolutely have to, or if it's a smaller face amount to get a bigger amount of coverage over a 10 or 15-year deal. So in this is really a good spot to, you said you still can do your term plans and still feel good about them because they're still able to get some 15-year options. Some companies may even offer some 20-year options. But if some of those older folks, you kind of start gravitating towards some of those more permanent style products to avoid using those 10-year terms. So like I said, typically you still see, I mean, 10 and 15-year terms are going to be some of the most popular. I try to steer towards the 15-year side of things. If a company can offer a 20-year term, might take a peek at it, knowing the premium will be a little bit higher. So I mean, at 15 years, usually the sweet spot to where even if, say, they're 60 or 65, I mean, 15 years gets them to age 75 or even to age 80. We're still a solid product and enough time left on the backside of it. Based off of current regulations where most companies stop selling insurance as being 85. I know there's a couple handful that go up to age 90, but for the most part, generally speaking, in terms of carriers, it's 85 is going to be the kind of the cutoff. So getting them to that age 75 or age 80, with still a couple of years left to get that last payment protection plan or that last whole life or burial policy, you're leaving it in pretty decent shape. Still be able to make some financial moves without being stricken to a policy going past 85 and then being stuck without buying any other coverage or trying to overlap the actual coverage. So so this bracket, except occasional 10 or 15-year terms, you might find a 20-year, but I'm usually trying to stick to probably about 15. Living benefits, it's a huge selling feature for the older crowds because at this point in life, more things are prone to happen: heart attacks, strokes, cancers. So being selling to those benefits, if you are doing a term option, really kind of sets them apart and kind of makes them appreciate having that term product a little bit more, as well as you start really looking at your whole life payment protection plans. Universal life isn't going to be as much for the retirement piece as it is at this stage in life if they're healthier, to be able to offer a little bit more face amount than your traditional whole life policy, as well as be able to get some of those living benefits. So, for example, the GULE, Forrester Smart UL, excuse me, those are both going to be able to write to up to 65, and then the other ones over Forrester's goes all the way up to age 75. So be able to give some people those that are healthy, the bigger face amounts that are still permanent, but also access to living benefits can make sense as long as they're healthy, to be able to use for that retirement era. Lastly, senior with a mortgage. So this is going to be your crowd from 71 to 80 plus. So a lot of people, they get scared about this crowd. You start seeing some of those bigger mortgages, especially some of those retirement destinations, your Florida, your Californias, the North Carolina, it's wherever it's warm, you kind of start seeing some older folks with some really high mortgage amounts. So in this segment, it's really, once again, it's very imperative to dig into what their why is and what they're really striving to actually do. But you want to put a lot of emphasis on the actual property, the stairs, the landscaping, the maintenance. Are they able to keep up with it? Even if they might be able to do it now, but 5-10 years later, are they still been to maintain it? What if their health changes? Is that home suitable to accommodate those changes, or would they end up downsizing or even selling? So this one, like I said, there are a couple term options still available for use. Typically above 70, I'm usually trying to stick towards the whole life permanent route, unless they're begging me to have a term option or they're super healthy in order to get one, or if it's a smaller loan period, like a 10 or 15-year loan, then I might pair it up with a 10 or 15-year product if at all possible. But usually, like I said, I want to do them justice. I'm going to kind of gravitate towards more of the permanent style payment protection plans, because it makes a hell of a lot more sense, to be honest with you. I mean, it locks down something permanent at an older age instead of them fighting 10 years later at age 80 or 85 trying to get that last final expense or whole life option. Be able to lock it in a little bit sooner makes a lot more sense for them, as well as it still accomplishes the goal of giving the family some options. They want to keep the house, downsize, sell it off, whatever they want to do with it. They have some flexibility and some house payments coming into them to make that choice on their terms, not on the bank's terms. So, like I said, you have your products used, 10-year terms. So are some living benefits still available? Like I said, mainly I'm usually looking at whole life products for the payment protection plans. So that is it from those guys. Let me stop the screen share. So a handful of folks on here, thanks for joining, but let's open up for questions. You should be able to all unmute yourself and, like I said, make this a nice little Q&A section. Anything in mortgage protection that we've either covered or any type of cases that you're dealing with, I mean, let's all have it.
I'm thinking.
Fair enough. Deanna, Rick, Roger, any of you guys got any questions? I know we talk a lot, but
yeah, well, I got a really quick one. I guess for tobacco, for like occasional cigar use, Foresters and Am don't do that anymore, correct? There's nobody that does that anymore?
Yeah, on term products, there's no company that's going to give you a non-tobacco rate. Any type of, either it's a gray area for the e-cigarettes and so forth, but occasional smokers, it's not going to lie. Am for the cigar use, as long as it's once a month, I think they still do that option for cigars, not for the cigarettes or dip. I know Forester's, there's a different product that we don't use. They take as long as everything but smoking cigarettes as non-tobacco. But we usually don't deal with that. We use your term product, so that's not going to be an issue for us. But in terms of how it was 3 years ago, where some of that stuff, if you smoke a cigarette once a month, we get those to slide through. If they kind of cut down on it, they changed the question to nicotine products versus the whole cigarettes. So it's a little bit more stringent. As I said, the only one it's really kind of tricky is that whole cigar use. Some companies still look at it as once a month is okay. But typically, someone says nicotine, I'm usually running the whole tobacco rate to make things safe.
What about weight? I know that, is it Phoenix or Columbia? Which one has like the more liberal weight?
Phoenix.
It's not on your term underwriting first looks, which I wish that was on there.
Yeah, I mean, weights, like I said, you got to use the height and weight grid. That's why we put that whole thing together for you. They're all, I mean, they're pretty close. They've changed some of them. Like I said, the America needs to be updated on there, but they actually went down in weight, oddly enough. But Phoenix is probably one of the most liberal ones. In the same token, though, if you depending on the product you write, either the express or the non-express, you can get table rated. So even though, yeah, they might be within range, but you also can get the backside of it and get them table rated with a little bit higher premium. I mean, my typical rule of thumb on build is you want to make sure, especially the people that are, say, they're 5'1.5". I'm going to round them up to the 5'1", as well as I kind of give them a wiggle room between 7 to 10 pounds. I call it water weight, so it's kind of a make your judgment call on it, see if it makes sense or not. Keep in mind, a lot of the carriers' weight is still an underwriting factor. So what that means, even though they have build charts, if they have some health challenges, like, for example, diabetes is probably the easiest one. Diabetes has a whole separate weight chart for most companies, or they get you into a separate tier of weight when you have some diabetes issues. So understanding those is, yeah, you might be borderline weight, just be able to save you your 5 pounds and kind of make you a little bit skinnier to squeeze into it. But then you start throwing health challenges on top of that, then they're going to get outside the table for ratings and get either declined or rated up severely with depending on the actual company. So, yeah, weight charts, you always want to peek at them. There's not really a, hey, here's the one to go to if they're really fat. But like I said, Phoenix is the one to look at first. America's second. But those are also two that you add in more health complications, and that whole weight chart really doesn't matter, to be honest with you. It's really
where is that height and weight chart again? Did you email it?
Google Drive.
Oh, God, okay. I hate Google Drive. Okay, I have to find it somewhere.
Yeah, docs.iibrokers.inc.com.
Docs.iibrokers. Hold on.
Or wait, hold on. Sorry, that's the email address. 1 second. Hold on. I just totally set that wrong. No, I said it right. Yeah, docs.iibrokers.inc.com. And so if you go under, hold on, let me share the screen.
Yeah, I think I got it coming up.
Good dog. Yeah, so it'll be under my folder. And yeah, IFG, term, and UL height and weight chart. So it kind of maps them all out. So the only one that needs to be updated is America, which they changed some of the breakdowns for height and weight. But
I'm trying to hold on. I'm trying to look at your screen is too small. Okay, so where did you find that at? Where in the?
Underneath, go to my folder, National Sales Trainer, Marques Pagan.
Wait, where's that at? Oh, wait, where? I don't see it in there. Oh, National Sales Trainer. Okay, gotcha. All right.
And IFG, term, and UL height and weight chart, or height and weight grid, rather.
All right, thanks.
Yep, yeah, it's it. America, we need to update theirs. It's like I said, they changed it by a few pounds, slightly off. But yeah, I mean that's like I said, that's where I look at them. That's where we put them all there for. Let me stop that screen share. There we go. But yeah, it's like I said, it's really height and weight's always the tricky one. Because like I said, it's not only for the health piece of it, it's just because they look at it from the underwriting standpoint and then throw in the health challenges, and most times you're going to be over the limits, even if you're borderline, because they're going to add that part of their actual. So slightly overweight or almost to the full build line, add in some diabetes, add in some blood pressure, it's very likely that's going to be a decline case.
Marques, you there?
Yep.
John. Hey, John here. How you doing today?
I'm doing well. Yourself?
Good. Listen, yeah, fine, thanks. I got a referral last night about 11 o'clock, which was nice, on some people I wrote prior with foresters. And he only has a tax ID. He's not a citizen, no social security, no green card and all that. And Chad, who you know, said that according to you, he thinks, I believe AmAm will be okay, according to Marques. And is that true?
It'll be the opposite. AmAm would not be okay because there is no permanent residency.
Okay. Well, the one other he mentioned was Liberty Bankers. How about them?
Yeah, that's the whole life option. So yeah, I saw that earlier, but yeah, it was.
Yeah, it's gonna be whole life. You're good.
Year. Yeah, looking at whole life.
Okay, thank you. Appreciate it.
Yep. Yeah. Green card, tax ID numbers. It's also a gray area. Personally speaking, foresters by far has always been the easiest for me, dealing with foreign nationals and so forth. They do require some documentation. There's a questionnaire for it. But in terms of people that have just a tax ID number term, like I said, typically it's AmAm and CFG, Columbia Financial Group, but both of which they're going to require some type of residency, some paperwork, either green card, visa. They're going to want some type of documentation showing that they're not here on the illegal side of things. So it kind of kicks them out where they will do it, but they need something else to help support it if they don't have actual social. So.
Excuse me, are you saying foresters will do it though also?
No. Foresters will not do it.
Yeah, they'll not do it. Okay.
Yeah. I'm talking about in terms of you get the foreign nationals in terms of their residence, but I forget what was the one. It was residence, but not resident visa, no green card. Foresters the one that actually approved it for me. So they have a questionnaire. As long as you answer it. So, for example, guy from the Philippines, he was here on a work visa, waiting on his U.S. citizenship paperwork. So, it's work visa, no green card. They actually did it, but he has a social. So, that's kind of we start getting into tax ID numbers. That's a whole other gamut versus having a social, having a license, but not a legal citizen quite yet. I said foresters, like I said, they've been the easiest ones to deal with on my personal experiences. You get to tax IDs, it's a whole other ballgame. Totally different thing. So yeah, that's just speaking on that general question, but yeah.
Okay, but Liberty's okay.
Yeah, tax ID numbers, Liberty Bankers all day long.
Great. Thank you. Appreciate it. Thanks.
Good questions. Any more? Keep them coming. I'm sure you guys have some objections. You guys get inside the houses. Think of the house you guys didn't close. They might have said something that stumped you. I mean, feel free to share those, and like I said, I'll give you my 2 cents on it.
Yeah, I got one that stumps me all the time, and I have to call you every time because I can't remember anything. Is the whole thing with checks? Oh, I don't want to pay right now. What are the different variations when somebody has a check or they don't have it? They don't want to give you your bank account right now. Talk about that a little bit. Does that make sense?
Yeah, so that goes back to trust. So if you get to the whole spiel, which is why we say draft bank account, once they say yes, they're going to draft your bank account, we say that within the first 5 minutes to, one, avoid those people. If they're going to give you any type of pushback about banking information, it's usually at that very first point of I don't give out my banking information to anyone, and you kind of can unpack it. And typically speaking, it's from a prior experience. Nothing to do with you personally. It's something either happened where someone hacked their account, they stole their money, or another company drafted twice, back-to-back in the same week. So always some crazy story that doesn't have anything to do with you, anything to really do with insurance companies. It's just someone drafted something wrong, and you're having to pay for it. So I say at the very, very beginning to, one, get that out of the way. But then if it comes up later, so usually I kind of go back and reiterate, well, I ask them, how do you expect to pay for it? So, because usually most clients are not going to like this actual answer. Well, remember, like I said, we can choose the date. It all happens. So when I'm going through that whole presentation or getting to the application, say, well, what bank account do you guys want to use for it? Like I said, you get to choose the day it all happens. You can set the exact day. You can do all this 30 days out. And a lot of people don't like saying that, but keep in mind, a lot of the term companies, they pay you upon issue, not on draft. So usually that doesn't matter for you. But it's letting them know that they're in control of when things happen. They usually feel pressured when they think that they don't have a choice behind it. They're just going to blindly take out money whenever things are fully approved. So helping them understand to where, hey, you get to choose the day it all happens. What day do you want this to actually start? You want to start tomorrow? You want to do 3 weeks from now? You do the 15th of next month? I mean, you got to be relatable to them and understand, say, I know how this works. I know you have a budget. And that's usually how I overcome it most of the times, is relating to them and letting them know I know how budgets work. I want to make sure this comes out on a comfortable day in between your paychecks or whenever the week you get paid. Just make them feel comfortable. If they still give you any type of pushback, and they say, okay, well, there's a couple other ways that you actually can pay for it. You can write a check today for 3 months of the actual premium, 6 months, or the full year. Which one of those would you rather do? And you try to just give them the straightforward question. You just got to sit there and wait. And
yeah, but I'm talking more about. So you just said I'm writing this down. Write check for three months.
Yeah. So okay, if you don't want to give me the bank account, so there's 3 other options. You can write a check for 3 months, 6 months, or 12 months. Which one would you rather do?
Okay, but the other part of it is, I guess what I'm really trying to get at is, does every carrier, pretty much American and Mutual and Foresters, the big 3, and then of course Phoenix and Columbia, do they all do that? So literally we send the application in. What about, the other option is where they send the application with nothing, and then once they get
most companies won't underwrite it without any type of form of payment. So
they will not. I thought there was one that we did where they sent it, and then I guess that was National Life. The guy he was actually a friend of mine.
I mean, like I said, those are options that fall off the books, to be honest with you. So if someone says that, where, oh, I want to see if I get approved first,
right?
Well, they're not going to look at it unless you tell them how you're going to pay for it, and because they're not going to, basically how it works, they're not going to spend money on underwriting if they don't know how you're going to, they say yes to you, how you're going to plan to pay for your actual policy.
Yeah, that's weird that National.
Yeah, those are those other companies, like you get the flyers inside the mail, or the USAs and ARPs, all that stuff. They'll let you do the application, then send in payment later to do monthly billing. But all insurance companies that we work with, now you said you might be able to send an application blank, but they typically want it with the actual check being mailed with it. So anytime I've ever got a quarterly payment, I literally fax the app over. I make a copy of the check, the live check the lady wrote out, send it in with the application, and then I'm mailing that check 2 days later, or if not a day later, whenever I have time to go to the post office.
Okay, so if I'm hearing you correctly, it's simple. If they're not willing to write you a check, even though they're saying, well, I want to get approved first, well, you're not going to get the money, but you have to send in a check. That's it. If they keep fighting, you get up and walk out, move on. Right?
Yeah, because what's going to happen, once you tell them how much it is for 3 months, 6 or 12, they're going to be like, well, I can't afford to do that. I'm like, okay. So the other option is you can choose the day it all happens. Because in their mind, which it makes sense, it's another story I tell. So I got this from it's a Brandon story. So he said, think about it. When you mail in a check, you probably do that thinking that you're more safe, right? Thinking that I'm going to mail it directly to that actual company. You're not going to give it to me personally. Thinking that it's going to be a safer route and it goes direct to the insurance company, right? Well, that same check goes through the post office and through processing, where anytime mail gets transferred from one place to the other, there's multiple people that actually have access to that mail. So if you really think about it, you'd rather deal with one person having that information, or you'd rather deal with 15 people having the same information. Not saying they're going to steal your money. Checks, they do get lost. And the same information that's on the bottom of the check, which what blows my mind, is the same information that you put in the bank draft form. So them mailing a check and going through multiple hands and multiple different people to processing different offices, it actually touches more hands than you writing it on an application and doing an e-app and going directly to the actual insurance company. So like I said, you have to relate with those people, and it's usually nothing to do with you. Sometimes, like I said, it is a trust thing, but it's not saying they don't trust you. It's something happened previously with them, and their money got messed up somehow, and they're very apprehensive about it. So it's as long as you relate with them and kind of understand, oh, this, I mean, yeah, someone, your bank account got jacked up, they overdrafted you two or three times, and just let them tell you the story. I've had the same people that say they're not giving me jack nothing, and then I let them tell their story about, oh, well, yeah, I mean, so I'm really apprehensive about it because this one time I gave my information to the cable company, and next thing I know, my contract was up, and my bill doubled, and I didn't recognize it for at least 2 or 3 months, and they didn't send me a single dime back. I'm like, oh wow, that is awful. Yeah, man, it happened to me too. I mean, like I said, it's those dang AT&T or the Spectrum. I mean, they had me for the 12-month deal, and the next month before I caught it, I mean, it went up to, instead of $60, it was 120. So telling stories and being relatable to some people, they understand they are a normal human being. You're no different than they are, and once you relate to them and kind of establish that whole connection and build that trust of, I'm just like you. I know you have a budget. I know you want to make sure your money's taken care of properly. You know you don't want to be drafted twice. That's why we can help you set it up to where it only comes out once. And you can choose the day it all happens. And like I said, they don't touch a dime until they actually say yes. So once again, do you want to do the first, second, third, 15th, or what's the name of your bank? Or you can go grab your checkbook for me. I mean, there's so many different ways to ask for the actual check. But sometimes it's just letting them vent about something that happened years ago. And hopefully that's going to be the actual better option. Or flip the script. Okay, that's fine. You don't have to do it that way. In order to get this thing processed, we got to send in either quarterly, semi-annual, or annualized payment. Which one do you want to send in for? And like I said, that kind of gets them to double check that, oh, maybe the monthly option is only $60 a month versus sending the company what, 180 or $200 a month. It's a little bit better for me. So otherwise, people that don't want to give you any type of information, they just want to see if they get approved. It's going to go back to, like I said, trust. What were they really looking for? Did the option you give them satisfy that whole need? Does the product really make sense? Do they understand the product? Do they even need the product? I mean, those are some of the questions you kind of got to go back and cycle through to the very front of it, because those types of objections, it's usually they've either got confused about something, they're unsure. You want to spend time going back, but then if they're still adamant about it, that's pack up, go on to the next house. It's not worth it. It's going to be a chargeback regardless. So you trying to fight her for another 30 minutes and going back in circles over and over, maybe try it once. It's not worth the time and effort after that. So does that answer that question? It's a long-winded answer, but it's happened numerous times though. I've had that happen before.
Perfect.
It's a good question though.
Yeah, I'm going to add to that a little bit, Marcus. This is Roger. But I think Mutual Omaha, if you do checks, they don't want the check right away. You have to mail it in after they mail you the policy. Because that's the whole life. That's what they have done with me a couple of times that I did the send a check or a money order.
So what are you saying? You're saying that you just sent in the application without any check or anything?
Well, usually I do e-app, so you send it in, and then once they get it, then they do their underwriting. And once they're approved, then they send that policy to you in the mail. Then you're supposed to send the check in after that. But like Marcus said, it's not a good way to do it. So because there's some people that are legit, but there's a lot of people that are just blowing you around. And about half the time that I've done that in the past, which I haven't done it many times, they just didn't want the policy once they were approved. So that was the reason.
Yeah, so the same token, you never want to leave the house without getting the actual check. Because otherwise, doing it that way, like I said, some companies they will do it, but it's getting that whole dollar amount commitment of, if I get approved, I'm willing to pay for it, I'm gonna pay for it, and I'm able to afford it. Otherwise, if you do it the way Roger just explained it, which isn't a wrong way of doing it, it's not as efficient, and you'll spin your wheels and waste a lot of time going back and forth to people. Say, okay, here's your policy, you're finally approved. I need that check for $300 something. It's always best practice, get the check while you're there, because like I said, they will underwrite the case for that. If we do an e-app and you say check with application or the CWA, but also the company is usually expecting to get the actual check within the next couple days. So, for example, I've done quarterly payments. Usually older folks, sometimes they're used to doing quarterly payments. So AMM done it that way. Phoenix have done it. But usually, like I said, most companies like Phoenix, for example, they won't underwrite the case until that check shows up into the new business office. So otherwise, you'll get bombarded with emails of still waiting for check. Did the check get sent? This put the not in good order. I mean, they'll do a number of different things to kind of still delay that until they actually receive that form of payment or that confirmation. Because I mean, some companies use that as a fourth verification step to verify that they have a bank account. That's how they verify who they say they are. Start getting to the whole compliance and money laundering stuff. I mean, that's why they do want those, either the account number you're going to use for it or the check with it, so they can know everything checks out. But easiest practice: get some form of payment before you actually leave. By some form, I'm meaning a legit legal form of payment. Don't take cash. I'm sure we all know that, but getting some type of commitment in terms of either voided check, live check, or routing an account number on the actual application for bank drafting. Getting something to kind of show for when you actually leave that house.
Hey, Roger, when you did that, when you were doing the EAP with Mutual, they let you go all the way through the process without putting any bank information in?
Oh yeah. I mean, I've done it a couple of times with the client did get the coverage, and yeah, that's how they do it. They will let you do the whole EAP. You just there's things to put in there. I can't remember what to put in there to, that it'll just pay, quarterly by check. There should be an option like that there, and that'll trigger it to go through to the end.
Hey, Roger, this is Deanna. I just tried to, I just did a Moo EAP the other night, and it completely shut me down without the banking information. I couldn't go any further. I don't know.
Was that a term?
Yeah.
Okay, that's a lot different. I was talking about the living promise whole life.
Okay.
Yeah, I mean, the options change once you go from bank service plan or monthly BSP is what Moo calls it, to quarterly or semi-annual. The options are totally different. So it's check mail with applications, usually what it ends up reading. But like I said, it's one of those things from business practices, you try to avoid it. It usually doesn't end well. This rule of thumb: get some form of payment before you actually leave that house to be able to send in. Otherwise, if you don't get it, everything goes on through. Now you're waiting to go back out to that client's house and scheduling another time to come out and see them. Stop by, get the check for the right amount. Then you got to mail that check to the actual insurance company. So that whole process that could have took an hour and 30 minutes is now drawn out to a 2 or 3 week process to get those policies issued.
I got one more question. I know it's somewhere on the carriers at a glance, but just real quickly, the EF, because they always keep changing it, and now this whole thing with Foresters, which you can't do unless you have an iPad. So for the term products, you have Mutual and of course MM and all that. There's no phone interview for that. But for these whole life, like Mutual, again, I've never done it. So if you're doing a Mutual EAP, whole life, living promise, or Foresters, can you you go through the whole thing, and at the very end, then there's a button you press, and then they say, okay, now do the phone interview? How does that work again?
There's no phone call for Mutual now. But,
there is none.
Yeah, but you go through the whole app. Just follow the prompts. Even on AMM's EAP, it follows the prompts. It'll ask you at the very end, call applicable. It'll go to a separate screen. You type in the phone call number, and then you submit it as normal. I mean, that's how they're all set up.
So you submit it before you do the interview, or you have to sit there and keep it in your computer?
You would submit it after the interview.
So get on your phone, do the interview, and then as soon as then hit the button to submit it. Yeah,
you have to go back in and sign it yourself. So you don't sign it on the actual screen, but yeah, there's on the EAP. It's for AMM. I'm talking AMM's EAP. It's super simple. It'll give you the prompts, give you the applicable phone number, tell you what to do, knock it out. You'll type in the actual PHI number. Then it goes back to the main screen, everything's done, and you review the application, and then you hit sign, which for you it signs it, but then you also hit submit to home office. Then everything's done.
And okay, and that's for mutual, AMAM, and Foresters.
That's just AMAM. The process I just said was AMAM's process.
Oh, okay. And then Foresters.
Mutual even.
I mean, mutual.
Foresters, no, there's no EAP for Foresters for whole life.
Right. Exactly. That's what I thought. I just thought if they changed.
And mutuals, it's similar to Americos. They're going to do the HIPAA policy first. They're going to do the front end check, and then you go through the health questions. And same thing, on-screen signature for the client, and then you sign it on screen as well.
That's for who?
Mutual. For their whole life. Did that answer that question for you, Rick? You good, Rick?
Yep.
Okay, so just making sure you didn't say anything back. So, yeah, like I said, it's like I said, theirs is slightly different. It's easier now, but there's no phone call required. If mutual needs one, they'll do it on the actual back end. But if you do the EAP, it doesn't require the phone call. So everything's kind of gearing towards America and how they're doing the instant decisions. Hate to say it, America is still the cleanest one out of all of them in terms of how it actually looks and the process behind it, which was a little bit glitchy from sometimes, but like I said, I've done with the iPad recently, and it actually is a little bit better on the actual iPad in terms of switching between the actual screens. AMAM's definitely different from when they first had it. It's a lot simpler process. It's not as bad as it used to be. So, yeah, I mean, definitely the best thing to do is try them out inside of a house. With AMAM, you can kind of get through the whole thing on a sample case and not actually submit it. Mutual, you don't have that option. You have to do an actual live case to do their EAP. But Americo, they have a whole demo site. You can do their EAP there. And most of your other companies, your Royal, your Liberty Bankers, they're going to be phone apps. Even Americo they have the phone app option as well. EAP's better. Personally, it's faster. And then everything else is your standard options. Paper with the actual phone call attached to it. Other than if you do SNL down there in Florida, I think you got to have a straight EAP. So, yeah, nothing's changed too much. Except, like I said, some companies are trying to get rid of the extra phone calls and doing a lot of the pre-end script check on the front end of the application versus on the back end to make it a little bit easier for you. Good questions. Any other questions or questions about products? I can't be that good. Come on. There has to be a handful more questions or something you guys are struggling with. You want a little 2 cents on it.
Okay, Marcus, one more question.
Throw it at me.
I don't know why. I just have a hard time conceptualizing or wrapping my head around the living benefits aspect when I'm going in for either just, let's say, a whole life or a term or mortgage protection. Why is that? And what do you have to say about that? Just to kind of put it into perspective so that, you can kind of bring it up to them and they go, oh yeah, well, that's a good idea. Let's kind of look at that, or let's incorporate that.
Yeah. So in terms of you're struggling understanding what they are personally, or struggling conveying the importance to them, to the actual client?
Kind of both, just the whole idea, just, I don't know why. It's just kind of like a block
So
I have.
what do you think they are? Or what do you think they actually do from your personal point of view?
Well, maybe that's part of the problem. Just kind of give me a quick rundown.
Yeah, so most companies are going to have 3 of them. So you have your critical, your chronic and your terminal illness.
Right.
Critical is the most important one. That's your heart attack, strokes, cancer, ALS, dementia, Alzheimer's. You're on your computer, right?
Yeah.
All right, yeah, give me a sec. Let me pull this
Sure.
up. I'm a visual guy. I'm sure just like you. So I mean,
Yeah,
that's literally, I tell that to clients. Well,
Yeah.
'cause, I mean, a lot of the stuff, it can be daunting to try to explain it word for word or have a real good idea behind the concept.
Well, I kind of do, but I just, for some reason, I block it out. I figured since you're here, just throw it at me again, and maybe you can bring it to life.
So same thing I'm doing here. I mean, I said brochures, I use them for everything. Just because it makes sense to do it that way. So this is a accelerated death benefit sheet from Foresters.
Mm-hmm.
They do a real good job breaking down all the different options. But yes, the big thing is to make it a part of your actual presentation. So once again, it goes back to relating with them. So depending on their age, ask them, I mean, do they know anybody that either had a heart attack, stroke, or cancer? Anyone in deer have that or deal with those types of issues? They might say yes. I mean, usually it's 1 out of every 3 people have either dealt with one of those options either personally or within their family. They usually should have some idea or know someone personal to them that's dealt with it.
Mm-hmm.
So create that common ground between them. So lucky for you. I always tell a joke. You probably remember the old school cancer policies that Mutual Omaha sold or Western Southern. Well, lucky for you now, all those options are actually included as an added feature of most of these mortgage protection options. So if it being a separate policy, it's already included in top of their actual benefits. It's a portion of the death benefit can get paid out to you. So kind of going through the first couple, like I say, chronic illness is anything requiring assistance for 2 or more daily living activities. Most companies are either 90 days. So consistently. So if you need help bathing, eating, dressing, toileting, 2 of 6 of the daily living activities for more than 90 days, you can qualify for the chronic illness. Forrester does theirs at 24%. Some other companies start at 24 up to 80%. They're all going to be different ranges in terms of the actual benefit payout amount. But it gives them, if something like that they basically require any type of in-home care to help take care of them, they're able to pull out some of that benefit early to help offset some of that cost.
Hey, Marcus, that
Yep.
24% though, explain that. That's 24, like say you're
Of the death benefit. So
Right, so-
$100,000, it's 24 grand minus the fee. So it's like 23,500.
is it 24 grand a year until it runs out if you
No,
still,
once accelerate 24% of the death benefit.
so that's it. So they 24,000 if it's 100,000 and that's it. You get your one shot and that's it.
Yeah.
Right.
So usually they do it annually for this particular option.
Yeah. And then the also thing, I think what John's maybe getting confused, it confuses me, and I've been doing it for a year and a half, and I'm embarrassed to say it, but like you said, Forcer's up to 95%, but then you've got Phoenix, which is, I don't know, whatever.
95.
What is that?
95.
Yeah, 95. So they're both the same then, right?
Yep.
And then what about their chronic?
Yeah, get the brochures because Phoenix is 95 on all 3 of them.
Oh, interesting.
Chronic illness is there too. They do 95% on that.
Right.
Most of the companies are doing 24 to 80. So it just, in Mutual Omaha, they're 80% on their actual benefits. Casey Life is 80%. AMAM is 195, and the other one doesn't count because it's separate.
Right.
95% on Royal. I mean, they're all, like I said, they're all going to be relatively over 80%.
Right, but Forrester's
all different.
Yeah, but Forrester seems to be the lowest on the chronic, the 24%, huh?
Yeah, that chronic is typically the lowest. Phoenix is abnormally high. It's the opposite thinking.
Right. And John, I might want to add, I'm not trying to take away from him, but a rookie move that, again, I continue to do sometimes is don't shoot yourself in the foot. Make sure that people can qualify for that term with the living benefits, because if you introduce that too early in your spiel, and then they're like, oh, I forgot to tell you that I'm whatever. And then then they want, oh, what happens to the living? It could backfire on you.
Yeah. So I always post those with it. That's what we talked about last week.
Well, Rick, wait 1 second. Well, go ahead and explain that a little bit more to make sure they're going to qualify. You mean that they don't have any any issues ahead of time? This
Yeah, like in other words,
yeah, okay.
make sure like they fit within the guidelines for term insurance. I mean, if you
Yeah, sure.
start talking about a lot of ailments and a lot, then so. But in other words, you give your spiel, but after and you're set that they're pretty healthy and they're going to get, then you start into your, by the way, I want to tell you about living benefit. That somehow you got to work it in, but don't work it in too soon because it might not be. And then they're gonna. That's happened to me twice that I can remember. Where then they're like, well, what about those living benefits? Well, then you got to start backpedaling and go, well, all you get is terminal illness, and they're like, well, what happened to the other? And then it's like it starts crumbling.
Yeah, I got you. Thanks. Yeah.
So I say you want to ask questions, lightly talk about them. I use them to post close. So I use them at the very, very end of it as oh, by the way, you get this, and this with it. It's like I said, I'm the one that told Rick about that because I did the same thing. I would get through the whole entire pitch. Oh, wait, you're way too fat. You don't qualify for term. You're going the whole life now. And everything we talked about, you get only half of it or none of it. So what option makes the most sense? They're like, well, hold up. You said first you're talking about this, now you're talking about this. I don't want to deal with it. I'm not going to do it, and then your appointment's done. So it's good to ask questions because you can relate to them and they'll kind of understand how they work. But like I said, don't mention they are included. Just kind of use them as a feeler if you're going to bring it up early to see how much they're familiar with them or if they know anybody that's dealt with those issues. And if they have, say, are they still working? Did they bounce back fine? Use it as some sort of bond and rapport aspect of it. Just don't start getting into the fact that, oh, well, every company includes these different options. Just kind of throw it out there, see how they respond to it. If they've dealt with people that had the same issues, then transition to basically saving that information for later and then bringing it up again. So you remember you told me how Bob had a heart attack and kind of messed up their financials for a handful of years. Well, like I said, this option actually includes this benefit for you, and it'll help take care of blah, 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 and blah. So, but critical illness, like if you got your chronic, you got your critical, this by far is probably the most important one. It's going to be your heart attacks, strokes, cancers, ALS, dementia, Alzheimer's, organ failure, organ transplants. Accelerate up to 95% on Forrester's end. Every company's different percentages. They could be 80, 95, and so forth. Lastly, terminal illness. Anything resulting in death 12 months or less. So all the way up to 95%. So that's what the main three of them are. It's that almost every company has some way, shape, or form of either all three of these, two of these, one of these. Big thing, though, to understand why I always recommend getting the actual paperwork. On the back of the Forrester's one, it gives you a numerical payout of what they can expect. So it's all based off of actuarial tables. So life expectancy, actuarial tables, and then the actual face amount of coverage. So you show this one, the guy's 45. There's doing, what one is this? This one is chronic illness. So that means bathing, eating, dressing, toileting. The $100,000 policy, they accelerate 24%, which is $24,000. Based off of life expectancy, they come up with basically they're able to get half of that money minus the admin fee. So it basically comes out to basically a $12,000 payout, what they're able to get of that 24% accelerated. They took it monthly. It's about $1,000 a month. But all it does, though, in terms of coverage amount, it just reduces the face down by 24,000. Also, the count value is talking about cash value. So if they have some cash, it does reduce that slightly as well. It also does reduce the payments. It's probably the big one a lot of people forget is even though all the numbers are changing, the amount of the monthly payment goes down with it as well. So it's important to understand the differences of how they actually work, but excuse me. That's why I would say up to. Never say the full 95% because it's always going to be based off of the actuarial amount. Life expectancy, it's never going to be that true dollar amount. It'll be a roundabout figure, but at least it's something out of the whole policy. The whole big thing to focus on, we're talking about living benefits, is the chance to get, if something like this, life-threatening happened to you, they fall into some of these categories, you have the ability to get some of your policy early while you're still living. That's probably the most important thing to actually talk about. Don't get, like I said, I wouldn't get too hung up on the actual percentages. I mean, you can talk about them, the brochures have them, but it's just the fact of we're able to get some of this death benefit without having to pass away. That's what's going to be the difference between your life insurance and your mortgage protection options or term life with living benefits. Same exact products that we use, but it's the ability to have some type of money out of your policy without having to pass away. So I kind of keep it at that point. It usually makes a lot more sense for them. Because like I said, I'm not promising too much. I'm not under promising as well. I'm just still talking about what benefits are truly available to them.
Excuse me, Marcus, are you saying then or suggesting that when you're talking about a whole life policy?
Whole life totally different. So you're looking at totally different living benefits on whole life products.
Okay.
So typically nursing home waiver premium, terminal illness is on there, confined care. It's a totally different string of benefits. I'm talking term products. These are what you're going to see on term.
All right.
Yes, I mean, I recommend, whatever companies you're contracted with is digging into each of the agent guides for all those different products that you have, and as well as getting the brochures for each of those products. That'll keep everything concise. Like I said, you don't have to memorize it all, as long as you can somewhat talk about each of them and be able to point them inside the brochure and give them the full paragraph on what it's actually talking about. I mean, that's all you really have to do is be able to help explain them and show them what's all there. So getting the brochures, agent guides, that'll probably be the number one step for you to start with, just so you have your hands on it. You can at least see it, and then it'll give you all the various bullet points. So for example, you're still screen sharing. Let me add. So for example, the year term brochure. So I mean, I'll give this out to people. Not because I need the information from it. It's just to show them the different bullet points. Here's all the different term lengths, 15, 20, and 25, and 30. Minimum, when I say minimum coverage 50,000, they're able to see it. It's affordably priced, competitive, it's convertible. For added value, these are included riders and stuff that's given to you. So yeah, your accelerated death benefits, which is your critical, chronic, and terminal, your common carrier,
right?
Family health benefit rider, natural disasters. Then for added coverages or added for cost benefits, they'll give them these rundowns here. So it just allows you just to put all that information instead of having to memorize it on your own sake of it. Just use what the companies give us. I mean, the stuff is all free to us. So order. Get boxes of it. If you look at my office, you'll see probably about 20 boxes of just forms and different carriers of all their paperwork, folders, brochures, just all that stuff. Just give it away. It makes your job easier from having to memorize everything and just knowing where things are. Having enough stuff to give these people, because what they're buying is something that's not tangible. So as I always say, as much tangible stuff that you can give these people to make them feel more comfortable with what they're doing and feel more confident behind it, the actual better. So, but no, that's a real good question. But if you look at on that same Google Drive, there's a couple links for the carrier trainings. There's one for foresters in particular that goes over their living benefits and how they actually work. Each company kind of has one similar on it, but it does a real good job talking about all the different benefits from each carrier. So you can kind of understand them, but I think the easiest way is always going to be the brochure itself. Just understand what you're giving to the clients to read up on. It's usually going to have a lot of information in small little nuggets. It makes it easily consumable in terms of information versus trying to memorize. Like, so the agent guides are good for us to be able to read and make sure to see what's all there, but the brochures are what's going to master those key points that are inside the paperwork. So when you're showing,
let me ask you that. That's all excellent information. I've sold. I hate to say this, and Rick, you might laugh at this too. I was with a former company, and I sold, a fair amount of foresters, and I love them. And I'm just getting back in with them this week because it's taken a while to transfer over. But my question is, I like the Advantage Plus a lot, and I've sold the term and, all that kind of stuff. But Is it good to bring these brochures out while you're discussing it, or does that get kind of confusing, or leave it after the fact, after you've already closed the deal?
It depends. If you're leading with foresters and you kind of already know what they end up qualifying for,
Yeah.
it's okay to show them. I mean, there's no harm in doing that. I mean, I pull out the forester living benefits sheet to explain the living benefits for every single company.
Right.
So it's just they do a good job of breaking it down and making it make sense. So yeah, even though it says, I mean, if you look at the form though, it doesn't say foresters till the very bottom. So it's kind of a universal form where I use it as, hey, here's how the three benefits look. Most companies have the same one. It's also how you set up the actual appointment. If you go in saying that I'm a broker, I sell for 15, 16 different insurance companies, and my job's to kind of help you shop, and you kind of lay that foundation of there's various different options, and just by showing you one form doesn't mean this is the one we're going to go with. But if you show them any type of form, just make sure if you switch to a different carrier, you switch the actual paperwork with it. So, for example, if I do a 2-option close between 2 different companies, right, or 3-option close between two different carriers, Foresters for 1 quote, Mutual Omaha for a 2nd quote. I might just show Foresters paperwork just to get the concepts down to make that drilled in. But when I go to, okay, Mutual Omaha makes more sense for you, just off of pricing, I'm going to switch out everything and just make sure that I leave them with the actual mutual paperwork with their green pamphlet and so forth, and highlight those same exact features that we already talked about, just show them that they're on Mutual Omaha's side. So like I said, I use that sometimes, especially if I'm doing basic term to ROP. I'm not doing the same exact company. I'm usually doing Foresters for the term, KC Life for the ROP option. Similar benefits, but you have to switch them out eventually. So it all just depends on your presentation, how you have it structured, how it's set up to kind of plug into it. But just to give them something to read up on while you're kind of going through the pitch and going through the quotes, it's never a bad thing. I mean, they might catch something that they like about Foresters.
Yeah, right.
I mean,
Right.
I leave the folder out. She picked it up, started looking at the member benefits. I didn't even start talking about those yet. I was doing the quotes to show them the actual prices because they're healthy enough to get it. She's like, stop writing down numbers. I want this company here. What options do I have for this exact carrier? So I mean, I've had that happen before, but
No, that's a great point. Yeah. Thanks.
so I mean, it's okay to let them read stuff. It kind of gets them, as long as they're engaged and they're keeping the same train of thought. End of the day, doesn't matter what company you end up selling, unless you're trying to win a trip or something, then it kind of does matter for you. But otherwise, I mean, you're coming out with the app, you're coming out with the actual app. So it doesn't really matter which company it's with, because they're all pretty fair in terms of the same things. But as you progress and get better underwriting, you'll know that, okay, this person has diabetes young, right? I know not to bring out this company, or this company. I'm going to stick to these couple. Doing it that way, like I said, once you get to the underwriting, probably after step 5, you kind of know the health wise. Then you kind of start talking about the perks and different things about each of those different products as you're starting to pitch the actual numbers behind them. Or after you pitch the actual numbers, here's their information of how this looks to help them kind of decide. But it comes down to, like I said, in-home style, how you're actually doing things, how you're showing numbers. Like I said, for me, I lead with Foresters, so I'm kind of talking about them throughout the whole entire process until we have to do a switch to a different company if I have to, or if they want a different feature that Forester doesn't give, then we're just going to pivot and just carry on. So definitely want to look at your personal style first and figure out which way you like to do things. But if you sold Foresters before and you really enjoy them, I would just lead with them.
Yeah, I do. Yeah, they're great.
And then just pivot to something else if you absolutely have to. But still, the information that Forester is going to give them is still solid information. Just don't give them the member benefit sheet. Obviously, keep some of that stuff separate. Don't fall into that whole trap, and then you'll get pigeonholed. So, but yeah, I mean, we can definitely talk further about it on a separate call. You gotta want some more insights. I mean, it's hard to diagnose you without hearing how your actual in-home pitch is to see where's the good time to plug in the information. So I typically do it is once I know their health, like Rick was saying, you kind of know the health piece of it. Then I might start throwing different things about Foresters or pull out the pamphlet to talk about living benefits briefly as I'm showing the quotes, kind of get their idea behind if they like them, if they don't like them. then I'll start gauging it along kind of the back end of the actual appointment, not so much the front end of it. That's my personal take on it, at least.
Yeah, that's great. Thank you very much.
No, you're welcome.
You too, Rick. Thanks.
All right. No, we're a little bit past time, but any last questions before we get off this thing, guys? I don't want to cut anyone else off that might have thought about something. Perfect. Well, if there's no more questions, once again, thank you guys for hopping on. Like I said, it was a nice little 4-part series. Look forward to doing more of these. Please give me the feedback. These are really good questions, and these are things that we can incorporate to do on the other series of spend more time and kind of go back and forth about different takes, get different people's opinions. So appreciate you, Rick, for hopping on and giving your 2 cents. Same thing to you, Roger. Appreciate that as well. But until then, have a good week, guys. I'll talk to y'all soon.
Thank you.
You're welcome.
Thanks, Marcus.